Hi, everybody, and welcome to what should be a very, very interesting discussion on our education series. I'm John Whelan. I'm two things, really. I'm the chairman of the board of the Enterprise Ethereum Alliance, but in my day job, I'm also the managing director of the Digital Investment Bank at Banco Santander. And a lot of the work that we do at Banco Santander relates to blockchain and DLT related concepts and ideas. And one of the things that I find personally interesting, although it has not entered into the consciousness of the banking space just yet, but personally interesting, is decentralized finance, DeFi. And with that in mind, I am delighted to welcome Ryan Sean Adams here today. Many of you probably know Ryan already from either Twitter, where he's very active, or his blog and publication Bankless. But Ryan is the founder of the crypto asset investment company Mythos Capital. He is the publisher of Bankless, a decentralized finance education publication. And as you probably know, he's quite outspoken and widely read regarding Ethereum and DeFi in general. So maybe, Ryan, you could take a minute or two to introduce yourself and give us a little bit of background about, where Bankless came from and what you think is exciting about DeFi. And then I'm going to act as a moderator and ask you some questions.
Absolutely. It sounds great, John. Thank you to the Enterprise Ethereum Alliance for hosting me today. Pleasure to be here. So yeah, as John mentioned, I am doing kind of two groups of activities really in the crypto space and the DeFi space and the Ethereum space right now. The first is my day job is sort of a crypto asset investor. And so I've got a capital pool called Mythos where we invest in various DeFi protocols, companies building infrastructure, and also the raw assets themselves. So assets like Ether, assets like Bitcoin, and others. The second project, and this is a passion project that's kind of turned into a bit more, is the Bankless publication that I host and I publish as well as a podcast. And I really launched that because I saw the seeds of an entire movement here. This is a technology movement, also somewhat of a social movement that reminded me a lot of the early internet in the decentralized finance space. And I kind of think of it as permissionless finance, as open finance. There's the ability to do all sorts of things on this programmable asset layer that we haven't been able to do before. I think it's kind of the missing piece of the internet. If the internet is a group of communication protocols and tools, then what crypto is doing, what Ethereum is doing, is it's layering digital scarcity on top of that, an asset settlement network to the internet layer. And so there's a ton of things that can be built on this. And it's so early days. I created Bankless to kind of build a community around keeping everyone informed as far as what's going on in DeFi. And then an emphasis, I think, and I think this is, John, is important. I hope we have an opportunity to talk about it today. An emphasis on actually learning these protocols by actually using them. So in crypto circles, it's been a lot about like one verb, and that verb is hold. So hold Bitcoin, those sorts of verbs. But I think the DeFi revolution is about doing other things in this open financial system. So not just hold, using other money verbs like lend, like borrow, like trade, and accomplishing those in decentralized ways. So it's young, it's nascent, it's incredibly fascinating. And yeah, I tend to spend as much of my career here as possible because it's just so fascinating.
Okay, so Ryan, give us a little bit of an idea of where DeFi, what is it, and where did it all start?
So I think DeFi actually started with Bitcoin. So Bitcoin was the first public blockchain, the first decentralized financial system. The white paper itself was a peer-to-peer money system, peer-to-peer currency system, if you will. And so that enabled two basic functions. So the function of holding, so you could hold Bitcoin, but you could also transfer it. So you could move Bitcoin from one Bitcoin address to another, and you could retain custody of that Bitcoin the entire time. So it required no intermediaries. It was peer-to-peer. So it's basically those two money verbs, holding and also sending, also transacting. Of course, lots of limitations with that. So, as we know, the Bitcoin network is only scalable right now to 5 to maybe 10 transactions per second. But nonetheless, that I think is where DeFi started. Decentralized finance, decentralized holding of a digitally scarce asset, decentralized sending of a digitally scarce asset. Then I think a second wave has really fully formed. There were other I think crypto networks that attempted to do a bit more with programmable money and add some additional money verbs, but I think that's really culminated in the launch of Ethereum in 2016. And what Ethereum does, I'll pull up a slide on this, is it sort of does more than just the money verbs of being able to hold assets and also send them from one place to another. You can create smart contracts on top of Ethereum for issuing assets, minting your own assets, or doing other things like borrowing, like lending, like trading, like engaging in sort of margin activities. All sorts. It kind of finishes the financial stack, if you will. It adds some additional money verbs to the mix. So where I think that started really with Ethereum in 2016 was sort of the birth of ICOs, and ICOs are really just a DeFi fundraising mechanism. So the ability to raise funds in a peer-to-peer way without a central intermediary. And of course, this very powerful concept, and it can also be abused. And I think we saw a lot of those abuses in 2017, where there was a lot of speculation and bubbles and maybe ICO assets that really weren't worth anything. Nevertheless, I think it was a demonstration of one of the initial use cases of decentralized finance. And now we're really seeing kind of a third wave. So if the first wave was Bitcoin, the second was Ethereum and ICOs, I think now we're entering the early stages of what might prove to be a golden age for DeFi, with the launch of all of these other DeFi protocols, money protocols, as I like to call them, on top of Ethereum, that can accomplish some other things. I hope we have an opportunity to talk about that today. But what it really starts to form is what you're seeing on the screen. So we've got a settlement layer with Ethereum that settles all of these digitally scarce assets that can be issued. And so I'm sure listeners are familiar with ERC20 tokens. These are tokens that can be issued, and they're fungible, and also non-fungible tokens. And then on top of that, we have this rich protocol layer of exchanges, of derivatives, of lending and borrowing that's popping up. These are the DeFi protocols, the lending, or the money Legos, as we've kind of come to refer to them as. And then on top of that, you start to get other interesting applications. So aggregators and exchanges kind of tapping into these protocols. And net, what we are looking at right now, I think, is the creation of a parallel programmable internet-first financial stack that exists and is in a parallel universe to the traditional financial system, but also has ties into the traditional financial system too. So it's, DeFi is really the birth of all of these things over the past 10 years, and kind of the culmination to where we are now, where each of these layers of the stack are being built out.
So a lot of the DeFi protocols further up the stack, they kind of rely on one or two core components. And I think one of those core components really is the stablecoin. And the very first stablecoin actually that was issued on the Ripple network, the original Ripple consensus ledger back in 2012. It was a dollar-backed stablecoin by a small company in Seattle called SnapSwap. I remember it well. I was kind of involved in the community at the time. But we've come a long way since then. And tell us a little bit about the stablecoin ecosystem as it exists today.
Yeah, I think that the stablecoin ecosystem is incredibly dynamic and one of the most interesting parts of this space right now. If if crypto has been looking for some killer use cases beyond digital gold, for instance, and speculation, store values, then really stablecoins might be it. So the current, I guess, trajectory of stablecoins, there is now over $10 billion worth of stablecoins issued on top of crypto networks. The bulk of those, the bulk of that value, so 75% or so, is actually being issued on Ethereum today. And what a stablecoin is it essentially solves the helps to solve some of the volatility problems that we've seen in native crypto assets. So, going back all the way to Bitcoin, Bitcoin was a really interesting and is a really interesting peer-to-peer value transmission network. But the classic problem is if I send you 1 Bitcoin today or a fraction of a Bitcoin today, I have no idea exactly like the value of what I sent you. By the time you receive it, it could be plus 10% or minus 20%. These are highly volatile assets, and I think that's in their nature. They are decentralized. They're not central bank managed, so they're highly volatile commodity goods with fairly low liquidity. So gold is still volatile, but it is much less volatile than something like Bitcoin because it has more liquidity and more history. So it's difficult to have a peer-to-peer money network that transacts value unless you have some stable units of value. So stablecoins really start to solve that problem. You can add stablecoins to these crypto networks like Ethereum. You can issue them as tokens, and you can use the Ethereum network to transact with them. And so they pair one-to-one with a fiat currency. So US dollars is probably the most popular denomination for stablecoins. And most of the stablecoins of that 10 billion that I mentioned are actually US dollar denominated. Now, there are a couple of different subtypes of stablecoins that I think are important to wrap our heads around. The bulk of the stablecoins that have been issued fall in this first category. If you're looking at the slides, they're all backed by real-world collateral. So that means the stablecoin itself, it settles on a network like Ethereum, but it is basically an IOU for dollars, traditional bank account dollars, in an account somewhere. So some popular stablecoins are issued almost by generally exchanges, so crypto exchanges like Coinbase or Bitfinex. Tether is the largest of the stablecoins, maybe something like 6 to 7 billion in value. I think actually probably a little bit higher than that, and that's issued by an organization called Bitfinex, which has had sort of a checkered history as far as fully understanding the transparency and what backs that real world collateral, those Tether dollars. There's also a fast rising stablecoin that's a bit more US based, a bit more audited, I suppose a bit more regulator friendly, that's growing very fast too. And that stablecoin is being issued by Circle, which is an organization from the Circle organization, and also Coinbase. That's getting close to $1 billion. So the first category of stablecoin, and by far the largest, are basically these real-world collateral-backed stablecoins. They pair one-to-one with a dollar, but each of those stablecoins are backed by a real US dollar in a real traditional bank account somewhere. There's also this new form, very interesting stablecoin on the right that you see. These are crypto collateral stablecoins. So these are not enforced by banks, if you will, by exchanges and that sort of thing. There's no traditional dollars in an account. They're completely enforced on chain by smart contracts. The largest and most established of these is called DAI. That is the actual unit. 1 DAI equals 1 US dollar. Roundabout. It kind of floats. It's a pegged currency to the dollar. But the unique thing is, in addition to being completely managed on chain, its value is backed completely by crypto collateral, so collateral that's available on chain, the bulk of which is ETH. So for every $1 1 DAI, which equals 1 US dollar, as you recall, there is the equivalent of $1.50 of ETH or other crypto collateral assets that are backing that DAI. So it's an entire credit, and lending platform that allows DAI to come in existence. I think that's a growing space, a really interesting space, a completely new space. And those are the two main categories of stablecoin. There's a third, which hasn't yet shown a lot of promise, but is sort of exists on paper. And that's a stablecoin that would be backed by no collateral, just essentially be backed by its future growth prospects. We don't have to talk about that very much because it doesn't really yet exist and hasn't shown any scale. So it's not even clear that it's feasible. Those two top stablecoin, the real world collateral backed and the crypto collateral backed, give us a lot of room to play in the stablecoin space. And I anticipate a lot of different designs that will be created using those two stablecoins in the future.
So I think it's relatively easy to understand, a fiat-backed stablecoin. If I have $10 in a bank account and issue $10 of tokens, then those tokens can be later redeemed for the $10. That's not a stretch of the imagination. But when it comes to something like DAI, as you mentioned, which is collateralized potentially by different types of crypto and indeed maybe even stablecoins themselves, can you give a little bit more detail about how DAI actually works? It's extraordinarily complex at depth, and we could definitely spend an entire hour just talking about DAI alone, but maybe you can give us a flavor for how does this collateralized with a little bit of algorithmic secret sauce stablecoin actually function?
Yeah, absolutely. And as you said, John, there's a ton of depth we could go to in this. So I'll try to provide maybe the high level of how DAI works. And I tend to think, again, back to kind of what I'm doing with Bankless education platform, the best way to understand this sort of thing is to actually try it out. So, it's sort of like the early internet. There are not very many people yet using these protocols. Just like in the early 90s, there weren't many folks who were actually logging onto the World Wide Web, as we called it at the time. But the best way to understand the potential of the technology is to actually use it. So you can actually use DAI today. You can use its credit system to open up a loan and mint your own DAI, which is the really exciting part. And there's no intermediaries in the process. But basically, the way it works is you've got somebody who wants to, say, hold an asset and maybe go long on an asset, take out a collateral loan backed by that asset. So this would be similar maybe to a mortgage, an equity loan of some type. A mortgage is obviously it's backed by the value of some real estate property somewhere. In the same way, the loan that you take out on Maker is fully collateralized. It is backed by the value of the collateral that you deposit in, and it's backed by at least over 150% of the value of collateral that you lock in. So if you wanted to take out a loan of one DAI, you have to deposit at least $1.50 worth of ETH, that is an Ether collateral or other forms of collateral that the system takes in order to mint that DAI. And when you do mint that DAI, you're effectively getting a loan backed by the collateral. So the folks that are looking to borrow are essentially the ones that are minting the DAI, and they become sort of debtors to the system. So a typical operation might be, I want to keep some of my ETH, but I want to mint some DAI. So I'll go into the system, I'll deposit my ETH as collateral, I'll mint my DAI, and then I'll go take that DAI and I'll do something with it. Maybe I will sell it on exchange for another asset. Maybe I will actually use it for payments. But the interesting part about this is the folks on the other side, the stability seekers, actually don't need to get involved in the minting process at all. They can just access DAI on an exchange like Coinbase, for instance. They could just be paid DAI, and they don't need to know all of the details of how to mint and how DAI is generated. So you've got kind of two sides to this market. You've got the folks that want to borrow assets, borrow against their assets, and then you've got just the general stability seekers, day-to-day users of the stablecoin. So the net effect is all of the DAI that exists in the market is backed by some loan, by some over-collateralized loan. And what happens is if the loan percentage gets below a certain number, so 150% is sort of the design baked into the maker system now, then that loan will be called. It will essentially be automatically liquidated, and that's essentially how the system remains solvent and over collateralized at all times. And the cool thing about this is all of this happens on chain through code. So there's no humans really in the mix. There's no custody in the mix. There's no exchange in the mix. It's all specified and clearly drawn out in code. And it's all fully auditable on the Ethereum blockchain. So at any given time, I can go look at the maker contract and see exactly how much collateral is backing DAI. It's fully transparent and auditable to anyone with an internet connection who can access the Ethereum network.
So just looking at the price of DAI in some of the charts, its peg is actually, I think, remarkably stable for such a novel concept. It tracks the price of a dollar within a few percent, sometimes quite tightly, sometimes a little bit more broadly. But okay, so now I've got an algorithmic collateralized stable coin. Try explaining that to your mother. So I've got an algorithmic collateralized stable coin that tracks the price of a dollar. And now I can make payments. I could log into my MetaMask account and transfer some DAI to my brother to pay for something or whatever. So I can make payments, and we understand how that works. But what else can I do with DAI? Can I lend it out? And if I wanted to lend out DAI and maybe have somebody pay me interest, how would I do that? So maybe you can share some light on what else you can do with your algorithmic collateralized stablecoin.
Yeah, absolutely. So this is where I think things get cool. So what we've created essentially with this algorithmic stablecoin is peer-to-peer stability, a crypto native version of an asset that's no longer volatile as Bitcoin was or as Ether is. All of that volatility has essentially been filtered out, and you're left with kind of a crypto native asset that's still completely verified on chain, has no intermediaries, but is now stable. So what can you do with it? Well, I mean, all of the other essentially money verbs are the sorts of things you can do with it. So you can, this is a depiction of other protocols, sort of these money Legos. But one thing you can do with it, for instance, is you could take it and put that DAI in another interest protocol built on Ethereum called Compound. So Compound will essentially, it matches, again, folks that are looking to borrow assets with folks that are looking to earn interest on those assets, and creates a algorithmic market out of those two sides of the market. So there's no order book, there's no centralized exchange. Again, it's all kind of executed in code. So what I could do is I could take the DAI that has been sent to me, or that I received somehow, or that I've minted, and I could put that in a protocol like Compound, and I can start earning interest on top of it. I'm essentially lending it out, almost like a money market account in a banking system of some sort. Only this account is essentially executed fully autonomously in code, and there's no sort of intermediary involved. So the interest rates for this are market set and vary. So these are generally variable interest rates. They're the money Lego of fixed rate loans hasn't yet been created on DeFi, but that's in progress. There are a number of groups trying to do that. But that's one thing I could do with my DAI. I could deposit it in Compound and start receiving interest. I think the interest rate right now is probably hovering close to the 0.5% range, to the 1% range. But in the recent past, it's been as high as double digits. And the interesting thing I think about these interest rates is that they aren't tied as much to the traditional financial system. So like the Fed rate, for example, doesn't influence them nearly as much as the market price of assets like Bitcoin or Ether. Those really influence the interest rates in this crypto system. So that's one thing you could do with it, but there are a ton of others, John.
So, I mean, actually, there's something that's worthwhile pointing out. There's a company behind DAI, at least originally it was called Maker, and the company behind Compound is called Compound, and both are funded by mainstream, top-tier, globally renowned venture capital firms. So this is an indicator that perhaps they're onto something interesting and cool. And they're still probably to some extent trying to find their product market fit. But when it comes to Compound itself, you know, decentralized lending protocol, again, there's some technical complexity there about how it actually works. But maybe you can give kind of a simple ELI5, explain it like I was 5 years old version of Compound.finance. How does it actually work?
Yeah, I mean, maybe we could sort of pull it up. So like this is what Compound Finance looks like. And again, this is just the user interface for it, but anyone can build a user interface on top of the protocol. It's completely permissionless. But what you see on the left are all of these assets that you can supply, it says. So these are basically money markets that you'd supply. So if I wanted to supply DAI to Compound, I could just click a few buttons, use MetaMask, which is a wallet extension in my browser, and I could begin supplying DAI at this rate. This is 0.86%. So essentially what I'm doing is I'm providing something that's a stable coin equal to US dollars, and I'm earning 0.86% on it. And I earn that every time a block goes through. So every 10 to 15 seconds, I'm earning some fraction of my annualized interest. That's sort of what it looks like to supply. On the other side is the borrowing side. So this is, again, these are the two sides of the market. So if I wanted to borrow some DAI against collateral, again, so all of the loan tools inside of DeFi right now, they're all collateral backed, because in DeFi, there's no notion of a uncollateralized credit system. We don't have identity, the money Lego of identity yet in DeFi. So everything has to be over collateralized so that we're certain that the loans are solvent. But I can supply some assets like Ether, for example, or any selection of these assets, and then I can borrow an asset on top of that. So I could borrow something like DAI again or Ether on top of those assets. I could do it with just a few clicks and execute my loan. I can close that loan at any time. And all of this, again, works in sort of a decentralized peer-to-peer way. So I am interacting directly with the blockchain. Now, there is this user interface on top of it, but this is an interface put together by the Compound organization, which, as you said, has some fantastic backers, venture capital backers, in Silicon Valley and other places. But since this is the protocol, Compound, the interest money Lego, if you will, can be plugged in almost anywhere. So I can access it natively in an app. There's a crypto wallet app called Argent, for instance, and I can click a button and start earning interest. I don't even know necessarily that I'm using the Compound protocol underneath. And so the way this works is, there's essentially some code like in the middle that sort of defines the lending and borrowing curve to sort of define what the interest rate is and what the spread is between lending and borrowing. And if any of the loans become under collateralized, just like with the DAI system, the Maker system, they are automatically liquidated so that the system remains solvent.
So one of the other things that's really interesting here is that when you have assets, oftentimes it is necessary to exchange them. And traditionally, to exchange an asset, you would go to a crypto exchange, deposit your asset. The crypto exchange retains the cryptographic keys, performs the order matching or the bids and the offers, matches the bids and the offers, and then you can withdraw different assets from that exchange. Now, over time, as crypto exchanges have gotten hacked or had security issues, gotten a lot better in the last few years, this concept of distributed exchanges or decentralized exchanges, also known as DEXs, has come into being. Tell us what a distributed exchange or a DEX is, and roughly at a high level, how does it work?
Yeah, I think decentralized exchanges are a really interesting area of growth. They started off somewhat slow, but over the past, I think, few months, 6 months especially, we've seen a lot of volume, a lot of activity. So not insignificant. Right here is a screenshot I took yesterday, and there's 23 million or so in daily volume, 250 million in 7-day volume. So they're growing quite rapidly. And I think there are different types of decentralized exchanges. So when we use the term decentralized, it's sort of a nebulous word, because there's kind of a spectrum of decentralization. There can be various aspects of the protocol that are decentralized and other aspects that are more centralized. But at its core, every DEX is non-custodial. That means, as you said, John, you don't actually have to give up the management of your private keys. You keep sovereignty of your own assets at all time. There's no kind of intermediary who has access to those assets. So, that in and of itself is a huge advance, because over the years in crypto, we have seen a number of exchange hacks. So 2013, there was the Mt. Gox hack, where a lot of Bitcoin was stolen in one fell swoop. And there's been no end to the amount of centralized exchanges that have been hacked due to poor security or other means. So this kind of gets around that. You keep custody of your assets in every decentralized exchange. Now, I think there are two kind of branches of decentralized exchanges that are maybe interesting right now. The first is an order book type of exchange. So this is exemplified by a protocol called 0x, for instance. And this replicates a lot of the centralized exchange functionality, in that it's completely peer-to-peer. So you have a seller and you have a buyer, and you're looking to match those orders. Only with a decentralized exchange, that order matching process happens all purely on chain. So again, it's non-custodial. There are aspects of that are still, of course, centralized. Somebody is running the user interface. Often the order books themselves actually are off-chain. So there are aspects that are decentralized, but at least it does preserve the self-custody aspect. There's another class of exchange that is, I think, a bit more interesting, and this is sort of a automated market maker type of exchange, a constant product exchange, where essentially you're not trading with an order book. There's no peer on the other side of the exchange. You're trading directly with a contract. You're trading directly with an algorithm. The first of these is just over a year old. It's called Uniswap, and it's purely an automated market maker, a constant product exchange, where if you can trade any asset in a permissionless way on Ethereum, and you're interacting directly with an order book, a bonding curve of some sort that sort of sets your price based on the amount of liquidity that it has. And the market share for Uniswap, you can see that actually in pink here, though it's one of the newer exchanges, it's grown significantly. And I think it's grown so significantly in particular, in part because it's so easy. It's easy to use. It's also able to be programmed, so you can kind of take the liquidity from Uniswap and build other things on top of it in a very easy way. It's completely permissionless in that way. And it's also pooling liquidity together in a way that order book exchanges don't. And I think that's what we've seen, sort of the success recipe with a lot of these early money protocols, whether it's something like DAI and Maker, or something like Compound, or even something like Uniswap. They are pooling assets together, pooling states together in these large smart contracts, and essentially creating efficiencies and liquidity through that. So it's sort of a peer to contract or contract to contract type of interaction, rather than a peer-to-peer like an order book type of interaction. But those are the two categories right now.
So in the mainstream financial industry, when you have pools of liquidity in different places, you can get fragmented liquidity in different prices in different locations. Is there a way with DeFi to go to a single point and figure out what the best prices are across these different pools of liquidity, or do you actually have to go to each liquidity pool one at a time and check yourself? How does that work?
Yeah, I think that's a really, really good question. So, I mean, we talked about early on, maybe we talked about the DeFi stack, right? So we've been talking about with Maker and Dai and Compound and Uniswap, the protocol layer here, this third layer up. But on top of that, you can have other layers. So you can have an application layer, you can have an aggregation layer. And that's exactly what we're seeing being built out. So if you have a protocol that provides liquidity and pools liquidity together, massive amounts of liquidity, and essentially liquidity is really nice because it's very much a network effect game. So the more liquidity you have, the better pricing, as you pointed out, you can provide, the better your protocol gets, and then liquidity begets liquidity. You end up getting more liquidity because you're offering the best prices. Well, aggregators can tap into those liquidity pools on top of Ethereum. So this is an example of an exchange called 1inch. And what they're doing essentially is they are aggregating all of the liquidity sources across all of the Ethereum exchanges, the Uniswaps and also the order book exchanges, like you could see the 0x relays there. And they're providing the absolute best price across all of those exchanges. So this is an aggregator, an application layer that's been built on top of these DeFi money protocols, and allows you to just interact with all of them in one fell swoop. And I think that's part of the beauty of the open financial system, is the permissionless nature of it. So an organization like the company behind 1inch, they didn't need to access an API, get permission from organizations in order to build this. It's a bit more like the internet. So if you want to create a website, then you can create a website. You could just access the native protocols like TCP/IP on the internet, HTTP, HTTPS, and you can create your websites permissionless. So are these protocols. So 1inch just basically built this aggregator on top of these protocols in a permissionless way, and is now providing a service to provide the absolute best price on any exchange that you want to make by pooling all of the sources together. So one of the, I think, killer features of Ethereum and open finance and these DeFi protocols is we use a term called composability. So they're a lot like money Legos in that you can sort of put your Lego on top of others and build really cool, interesting things through composing them all together. And aggregators are just one example of that.
So when we think about, we've got, algorithmic stable coins, we've got decentralized exchanges, we've got composability where we can plug different things into different places. The natural question that comes up, my colleagues in the financial world will say, hey, what about derivatives? Which itself is a complex area. Tell us a little bit about, what's been done in next generation semi-derivative type DeFi protocols.
Yeah, so I think that when you think about derivatives on open finance, they're really possible once you have a few core building blocks, and I would maybe point to two core building blocks. The first is a price oracle of some sort, right? So externally to the system, you need a way to get the price of a certain asset. So maybe it's the price of a commodity like gold, or maybe it's the price of US dollar. Once you have the price, then you need some sort of a store of value, a value store like an asset like Ether, or a stablecoin asset like US dollars. And then if you combine those things together, so you basically have a store of value, an asset of some sort, and then you have a price oracle, you can basically create synthetic assets and derivative assets for just about anything. The asset that we talked about earlier, Dai, that is essentially a synthetic asset of sorts. It's not real US dollars. It's pegged to the US dollar through a price oracle and through the value of collateral that backs it. So again, once you have the collateral and the oracle, you can create all sorts of interesting synthetic assets on top of open financial systems like Ethereum. One group that's doing a lot of this right now is called Synthetix. So they are creating synthetic assets for basically just about anything. So you could create an S&P synthetic, for example. This is a token that tracks and is indexed to the S&P. And again, all you need is some collateral, some value store, and then a price oracle. And so when you mash those things together and you mediate those things through a smart contract, then next thing you know, you've got a token on Ethereum that gives you price exposure to the S&P. And they've created gold synthetics. They've created synthetics for various fiat assets. And I think the major thing that needs to be further developed in this space is essentially getting better collateral sources, better stores of value. So US dollars entering the crypto system, for example, through stablecoins, that's one example of that. Maybe at some point we get tokenized T-bills and tokenized bonds. Those assets will enter the system as other forms of collateral. And if you combine that with price oracles that are decentralized and permissionless, then you can create almost anything on top of this open financial system. So an extremely exciting area of development and something new happening almost every week on the synthetic front.
So I'll tell you what, I see we've got about 10 minutes left. I've got a couple more questions, which I think will take about 5 minutes of those, and then we'll open up some questions to the audience because I'm sure there's all kinds of interesting comments and questions out there. Regarding complexity, I think a lot of us who've touched this space or looked at it realize there has been some noise recently around this concept of flash loans. Another DeFi protocol type product. And they're not really loans as such, and they're not really flash loans. I like to call them arbitrage circuits, which I think is probably what they really are, analogous to things we do in the financial industry. Maybe you can explain a little bit about how those work, and then we will probably go to questions.
Yeah, sounds good. So a flash loan, as you say, or an arbitrage circuit, I think is a great way of thinking about it. Is the first, I said earlier that in DeFi there's no notion of having uncollateralized loans. All the loans on DeFi have to be collateralized because there's no identity and no notion of credit. There's no FICO score, if you will. The flash loans are one exception to that. And the way a flash loan is achieved, it's kind of like a 10-second loan that you can take using a money protocol, a DeFi protocol pioneered by a group called Aave. And basically it allows you to borrow a loan of any amount within a block. So Ethereum blocks are produced in 10 to 15 second intervals, of course, and every 10 to 15 second a new block is produced, and after that block is produced, then all transactions within that block are effectively settled. Well, in that 10-second period of time, if you can create some code that essentially uses the flash loan and goes and borrows some collateral, does something with it, so maybe execute some arbitrage opportunities, as you say, and repay that loan all in that 10-second period of time, all within the same block, then you've just created a flash loan transaction. So there's a lot of cool things that can be done with that. So one of the things that we've mentioned earlier is, well, if you take out a loan on Compound or Maker and it falls below the threshold collateral backing, you're effectively margin calls and you get liquidated. Well, if I've got a loan in Maker and let's say it's backed by ETH right now, what if I want to substitute that $100 in ETH for a different collateral source? What if I want to substitute that $100 in ETH with USDC, so it's a stable coin that we talked about earlier. Well, I can do that in one transaction. I can click a button, execute a flash loan, and I can swap out my ETH for that USDC. And it doesn't cost me very much. The flash loan provider takes a very tiny cut of that, and I've just swapped out my ETH for USDC in one block in a very efficient way. So lots of cool things that can be done with that. There's also some security vectors it opens up, because kind of acts as a arbitrage predator, if you will, in the DeFi landscape. Because now that if you have flash loan capabilities, you can really execute some pretty sophisticated and hairy transactions that can get certain DeFi protocols in trouble, and that's been done recently as well.
Yeah, I think that in that regard, as these kinds of protocols mature, it will be somewhat analogous to how arbitrage is used in mainstream finance. And arbitrage is really about the simultaneous buying and selling of similar assets in different markets, a spread in price between those assets in the different markets, and ultimately that helps narrow the spread in price between assets in different markets. It actually has arbitrage has a long-term kind of stabilizing effect in the financial industry. If possible, let's try and open this up for questions from the audience. I think it would be a good thing. And then before we close out, very shortly before the hour is up, I'll ask one final question. Just asking our controller here, how do we take questions from the audience?
Hi, John. We have questions. If you go, I can read them actually to you. So we have 10. The first says, hi, Ryan. What do you think about the Actis protocols regarding DeFi?
I may have missed the exact protocol. Can you say that again?
The Actis protocols, ACTUS.
I'm actually not familiar with the Actis protocol. So here's the thing about DeFi is I spend every single day in this space, and there was a time where I kept up with everything that was going on. That time has passed. So it's kind of like you're trying to track all of the websites on the internet. There was a brief period of history where that was possible. Now it's no longer possible, and I'm afraid I'm not familiar with that specific protocol.
Okay, great. We have another question. How about the importance of oracles in probably true data to trigger smart contracts?
Yeah, I think the importance of oracles, I think that the importance of oracles cannot really be understated. So all of the synthetics that we were just talking about, they're dependent on some sort of price oracle. And the oracle problem writ large is if you want to bring any data that exists off-chain in the real world into Ethereum, and you want to do that in a trustless way, it's actually very difficult to do, right? So you could get a price feed from an exchange, for instance, that tells you what the price of US dollars is against an asset like ETH, but how can you really trust that exchange? What if the incentive to manipulate that oracle becomes inordinately high, as the incentive can become for some of these chains? If maybe a Coinbase had the ability to kind of manipulate an oracle, insider, an employee of Coinbase had the ability to do that, and walk off with a ton of collateral from Maker. So what you have to do to solve the oracle problem is you have to get price feeds from multiple sources. That's what the Maker system does right now. It gets oracle prices from 15 or so sources and kind of medianizes that price in order to get a more decentralized version of the truth that's a bit more like it's very hard to manipulate by a central provider. That's one way to do it. There's also another way to do it, which probably don't have time to get into, but that is you could use an automated market maker like Uniswap to actually give you a price feed, and that can be conducted completely on-chain. That's going to be in the next version of Uniswap. I'm super excited about that. There's another protocol called UMA protocol that's trying to do the same thing, basically eliminate the need for off-chain price feed oracles and derive price all through on-chain liquidity sources, and that's super cool. So the Oracle problem is, I guess, slowly being solved, but it is a super important problem area, and I think unlocks a whole bunch of potential on DeFi right now.
Thank you. We have another question.
We've only got 2 minutes left. Oh, go ahead. We'll take one more. Ryan, answer it quickly, and I'll ask one final one.
Okay,
Perfect.
Thank you. What are your thoughts around potential regulatory scrutiny in this area once DeFi grows and stops flying under the radar?
Wow, I think the regulatory scrutiny will be interesting in the future. I will say, and this is respect to U.S. regulators, they've taken I think a cautious approach, and I'm really optimistic actually about the approach that they've taken in this space. One thing I guess I'll leave you with on this is, the CFTC has approved Bitcoin as a commodity. Did that a number of years ago. Just this week, so on Monday of this week, the first Ether future, that CFTC regulated Ether future market was launched in the US. So I think that regulators are approaching the space with caution, but they're not clamping down, they're not shutting down the innovation, and there's some slow but gradual steps towards regulatory clarity and progress in a good way, at least.
Okay, final question from me, Ryan. I think I know what your answer is going to be. What is the future of DeFi?
Wow, so it's a niche right now. So there are about 150,000 DeFi users, people like me, are using these protocols on a day-to-day basis, hobbyists in a lot of ways. But if the monthly rate of growth grows, that's going to be 10 million by next year. So it's just growing tremendously quickly. DeFi also crossed a threshold of $1 billion of value locked inside of the protocols that we talked about, crossed that threshold in February. So it's a niche market right now, but it's growing so fast. And for me, in kind of charting the progress of the early internet and making the analog to basically the internet of finance, internet of money, as what I think Ethereum and open finance is, it's going to be absolutely massive. We're going to onboard millions and then eventually billions of folks into these open financial systems over the coming years. There's a massive role for companies to play in the space, massive role for traditional banks to play in the space. And I couldn't be more excited about how it evolves. So I am bullish growth. I think this thing will grow like the early internet did and will change every aspect of our life.
Well, folks, unfortunately, we've just about run out of time. I want to thank Ryan. What an informative and enlightening presentation, discussion, so much to learn, very exciting. I would urge all of you, by the way, to visit Ryan's Bankless blog. It is bankless.substack.com, or to find Ryan on Twitter, where you can be sure to find him getting in flame wars with the Bitcoiners. Always fun to follow. With that in mind,
absolutely.
I just want to say from the Enterprise Ethereum Alliance and from myself, thank you very much. See you all soon.
Thanks a lot, John.